Hey everyone, welcome to The Explainer. So if you're a focused learner gearing up for your ICAI exams, you are in exactly the right place today. We're going to completely hack AS9, revenue recognition. Seriously, we're taking what is usually a super dry list of accounting rules and flipping them into high-yield, totally easy-to-remember exam cheat codes. By the time we wrap this up, you'll have this structured, visual framework just locked in your brain, absolutely ready to deploy on your next paper. Let's get into it. Okay, let's dive right into our roadmap for today. We'll be covering 1. The core of AS9. 2. Active income rules. 3. Passive income rules. 4. Handling uncertainties. And finally, 5. Final exam strategies. Section 1. The core of AS9. What exactly is revenue? Before we unleash the complex exam tricks, we just need to quickly anchor ourselves on the actual foundation of the standard. Revenue was officially defined as the gross inflow of cash, receivables, or other consideration arising specifically from the ordinary activities of an enterprise. Now, the absolute crucial point here, the thing you've got to remember, is that revenue must always be measured at the gross amount of consideration receivable. When you're doing your exam calculations, the literal millisecond you see GST, sales tax, trade discounts, or quantity discounts pop up in a word problem, exclude them immediately. Just kick them out. They absolutely do not form part of your AS9 revenue. Now, knowing what to include is obviously important, but knowing what not to include, well, that's a classic exam trap. You really must memorize these specific exclusions before you even try applying any AS9 rules. If a question brings up construction contracts, nope, that's AS7 territory. Government grants, that's AS12. Oh, and hire purchase transactions and insurance contracts, also completely excluded from AS9. Listen, the examiners literally love to throw in a hire purchase scenario just to see if you'll accidentally apply AS9 principles. You know they do it, so don't fall for it. Section 2, Active Income Rules, Sale of Goods and Services. To chunk this info effectively so your brain actually remembers it, we're going to group the sale of goods and the rendering of services together as active revenue. And for the sale of goods specifically, I want to introduce you to your absolute secret weapon for exam day. It's called the SRRC rule. When you're writing out one of those long-form answers, hitting these 4 letters will pretty much guarantee you secure full marks for the revenue recognition criteria. Let's actually break down these SRRC steps. S stands for significant risks and rewards of ownership being transferred to the buyer. The first R means the revenue can be measured reliably. The second R requires a reasonable certainty of collection. And finally, C means effective control is no longer retained by the seller. And this brilliantly illustrates how these 4 criteria definitively lock together. Like, think about it. If a scenario tells you the goods were shipped, but the seller still holds all the risk of transit damage, well, the S hasn't been met yet. So, no revenue. Okay, pivoting really quickly to the rendering of services. When you get a theory question on services, you literally need to write down these exact methods. Revenue here is recognized either as the service is performed by using the proportionate completion method, which basically means you recognize revenue proportionally as you finish pieces of the job, or, where it makes sense, the completed service contract method. And that's exactly what it sounds like. You simply wait until the entire job is done to recognize anything. Keep those specific terms super handy for your short answer sections. Section 3, Passive Income Rules, the IRD cheat code. Okay, so we just looked at active business operations, right? Now we're going to use the rule of contrast to shift our focus over to passive income sources. Listen, if you only remember one single thing for the multiple choice section of your paper, it absolutely needs to be this mnemonic, the IRD rule. It stands for interest, royalties, and dividends. These 3 passive income streams have very specific, honestly very rigid, triggers for exactly when revenue can be recognized. Let's see how this builds out the whole IRD framework. I is for interest, and that is strictly recognized on a time proportion basis. You have to look at the amount outstanding, the rate, and the time period. Next, R is for royalties, and those follow an accrual basis in accordance with the exact literal terms of the agreement. And D is for dividends, which hinge purely on one thing: when the owner's right to receive payment is established. Notice I didn't say when the cash hits the bank account. It's when the right to actually receive it is officially established. Section 4, Handling Uncertainties, a major exam trap. All right, this is where the examiners really like to separate the prepared students from the rest of the pack. What happens when the collection of your revenue suddenly becomes doubtful? Well, here is where the timeline dictates everything. If the uncertainty regarding collection exists before you recognize the revenue, the rule is crazy simple. Do not recognize the revenue at all. You just wait. However, if the uncertainty pops up after you've already properly recognized the revenue, actually, you do not go back and reverse your revenue. Please don't do that. Instead, you recognize the doubtful amount as an expense. Now, what's really interesting about this is that treating post-recognition uncertainty as an expense rather than a revenue adjustment is basically a guaranteed way to save marks on a tricky test question. Just before we hit our final summary, a really quick note on disclosure requirements. Look, writing down these 2 exact bullet points is just an incredibly easy way to grab those final few points on a long-form practical question. You absolutely must disclose 1, the accounting policy adopted for revenue recognition, and 2, the specific methods used for recognizing revenue from different sources. It's that easy. Do not leave those easy marks on the table, guys.
Section 5, Final Exam Strategies, the ultimate cheat sheet. Okay, we're in the home stretch now, distilling everything down purely for high yield retention. I want you to think about this actively for a second. According to official ICAI exam notes, what do you think is the single most frequently tested concept in all of AS9? Any guesses?
It's this right here, the exact basis of revenue recognition for different types of income. Honestly, I urge you to literally take a mental snapshot of this master summary table. Sale of goods links to the transfer of significant risks and rewards. Services link to performance or proportionate completion. Interest goes with a time proportion basis. Royalties align with the accrual basis. And dividends lock in when the right to receive is established. This one matrix encapsulates the vast, vast majority of AS9 theory and practical questions you're going to face. So what does this all mean for you? Well, here is my final challenge. The next time you see a complex revenue problem, don't panic. Take a breath and ask yourself, is it active? Is it passive? And where exactly is the uncertainty? Can you deploy the SRRC and IRD cheat codes to just instantly find the solution? Go open a past paper right now and test them out. You've got the structure, you've got the rules, now go secure those marks. Thanks for joining me on The Explainer, and happy studying.